First of all, let me thank you all for coming today. Thank you for taking time out of your day to come and get educated on trading on the markets. Today we're going to be talking about the first component, really, of any successful trading plan, how to generate consistent trade ideas. And I just want you to know that the subsequent webinars will be about execution of these trade ideas, management of these trade ideas, and then the fourth webinar will be on the psychological impact of trading and the performance endeavor, which is trading, and what that entails, what that involves. So we have quite a lineup of webinars for you, which I hope you'll enjoy. I am Justin Paolini, Head of Trader Development here at FCI Markets, and let's get on with the show. Before we start, please read the risk warning. Our investment products and services are not suitable for everyone. It is possible to lose all or part of your investment. For leveraged products trading, it is possible to lose more than your deposit. Trading on margin carries a higher level of risk, and it is possible to be required to deposit additional funds. You should not invest money you cannot afford to lose. So, just briefly about me, the only thing that's important to know about me is that I spent most of my career on the retail side, and gradually working through the retail side and learning more about the markets, I've been lucky enough to get in touch with some market professionals. Gradually, I graduated from the retail side onto the professional side. Now I'm assisting at 3C Analysis, providing analysis to institutional clients, and I'm working with some of the best traders in the world here at FCI Markets. So what does this mean? It means that any questions or any doubts or anything at all that you want to ask, you're not just asking me. The answer that I'll be able to provide you comes from the wealth of knowledge of our traders here at FCI. And the second thing is that having been through the retail side for most years, I've probably made every mistake in the book twice. So hopefully that's useful in educating you. Let me tell you a bit about our objective here at FCI Markets. This isn't just a webinar to tell you about trading. At FCI Markets, we are always looking for capable traders, passionate traders to join our team. We have space at our offices in Blairkay in the UK, but you can also trade remotely, and we can fund traders. And of course, you can get in touch if you already have a successful trading strategy. Otherwise, following our webinars, following all our education, hopefully you will become a consistent trader in due time, and then come and get funded and officially become a professional trader. So, on to today's subject matter, how to generate consistent trade ideas. Now, the premise for this is that there is a ton of free information spread across the internet and in the 10,000 odd books that have been published on trading up to now. So then why does this still happen? What I'm showing you here is from my FX book, and it is the positioning, the aggregate positioning of retail traders on the Eurodollar. What I'd like you to show is that since basically the beginning of April, retail traders have been net short on the euro all the way up. So despite all the education out there, despite all the books on trading, despite all the information on the internet, most traders, unfortunately, still fight trends and they try to catch tops and bottoms for some reason. And that's why over 70% of retail traders, on average, lose money. So what we're going to do in this webinar is identify 4 potential reasons why this may be and offer some solutions. So the first issue of why people probably lack consistency at all in their trading is system hopping. And this picture here, I apologize for the colors, it's a bit old. It's a picture that was drawn by my fiance back in, I don't know if it was 2010 or 2011. Basically, this was just illustrating how many things we had tested back in the day. And how many times we went back to the drawing board. I mean, literally, this is a drawing board, and literally we went back to the drawing board so many times. So why do people fall into this trap of system hopping? I think the first and the most evident one is that they are searching for the Holy Grail. People lack the knowledge to understand, what trading is and what it entails, and they think that they can just sort of game the system. If they find, the way, if they find the magic pill or the magic indicator, whatever it is, they have to find the way to trade the markets, the way to make money. And oftentimes, what they'll do is they will go and they'll look at the former market wizards. They'll look at Warren Buffett. They'll look at Ray Dalio. They'll look at Paul Tudor Jones, and they'll try and understand, what these people did, and they'll try to, apply the same principles. When the fact is that unless you're really inside these guys' head, unless you really know what they're doing in detail, it's impossible to copy them or to emulate them. But the other thing is, there really is not a holy grail system out there. And the more I've worked with professional traders, the more I've worked with, with break-even traders, struggling traders, successful traders, and helping them achieve performance, the more I've seen that, there are some general best practices in the markets. But each trader then creates a system that is personal to him or to her. So there is no holy grail, but people don't want to hear that. The second thing is scanning social media for profitable traders to copy. So this is sort of like, searching for the holy grail, but it's a bit different because as struggling traders, you approach the markets looking for guidance, just like in any other job. But since professional traders are sort of secretive about their work, it's hard to find out exactly, how to work a strategy from A to Z. And what people do is they'll scan social media. They'll look for charts or for account statements from profitable traders that are on there, or supposedly profitable traders. And that is an issue for two reasons. The first one is that it takes power away from you, because you are always looking for a better idea. You're always looking towards somebody else to feed you information or to tell you what's right and what's wrong. When instead, profitable traders all have the same thing in common, which is that they work their own edge. They study for themselves. If I tell them that, trend trading is the way to go, they'll take that piece of information, but then they will study it just to make sure it's true. And if it's not true, they'll find something that is true. So, that doubt, trickles into number 3 here, which is constantly doubting their own research. As a trading educator, as a trading coach, it is sometimes difficult to maintain that balance for me, because I have to coach people and help them discover what their strengths are and to help them focus on building their strengths. The mentor in me wants to sort of tell them what I believe is true, but they're only my beliefs. And I've been working on them for years. So it's true that they work for me, but they might not work for other people in exactly the same way. So instead of telling people, which instills doubt, because they're always asking themselves, what would Justin do? Or, what would trader XYZ do? What would Kevin do? Our head trader at FCI, Kevin Conlon, what would he do? That is not the way you're going to become consistently profitable in the markets. You need to find your own way. We can give you information, we can lead the way, but at the end of the day, it is you that will have to do your own research and find out if it fits you. And people just don't do this work. The fourth piece is unknown unknowns. Knowing that the markets are inherently uncertain, and not knowing if your system is going to work, not knowing if your system will work for 1 year, for 2 years, or just for a couple of weeks, not even knowing which systems do work or how to approach it. There's a lot of fear when approaching the markets. And so another reason why traders hop from system to system. This is sort of connected to number 5, when everything works sometimes, but nothing works all the time in all market environments. So this is something that happened to me many, many years ago, when I would start to apply concepts, simple concepts, but they'd work in certain environments, and then the market conditions would change, and I go back to the drawing board, thinking that it's the system that I'm not applying correctly, or thinking that something's wrong with the system, when instead it is the market environment that simply changed, and I wasn't able to sort of understand that and stay seated until the markets then kicked back into gear in a way that was facilitating the model I was working at the time. So basically, you can't apply the same thing across the board everywhere, every day. It doesn't work. And that's why I'm talking about here no patience and short-term gains. Most people treat the markets like a slot machine. So it's all about the short-term gains. It's all about logging in after work, looking at stuff for 15 minutes, trying to place a trade, and try and pull down some cash from the markets. And it just doesn't work that way, unfortunately. This is a competitive environment. It is one of the fiercest environments probably in the world, because it's populated by some of the most intelligent people in the world, and they're all trying to do more or less the same thing, which is make money and guess what the market's going to do next. And it takes patience, and it takes a focus on the long term to make any headway in this game. There was a good book years ago called Risk Intelligence. I can't remember the author off the top of my head, but Risk Intelligence was a study of professional gamblers. And of course, it's very relevant to also professional traders. And the professional gamblers all had a long-term approach. And it was, since they're all working with odds, not with certainties, but with odds, just like we are in the markets, they would basically annualize their behavior, and they would always think, okay, if I take this kind of bet, I might be lucky once, but in the long term, taking this kind of bet, what will happen? So they're always thinking about the long term and about their habits and how they would stack up, whether it's professional, whether it is, whether it has a future or not. And unfortunately, most traders just don't do that. I feel for the people that have taken the employment benefits in the U.S. that the $600 odd they were receiving each week, and they were dumping it into the markets. They were dumping it into stocks, and I really don't know how that's even possible, because without a proven system, you shouldn't really be throwing money into the markets at all. And this is all about, of course, what the wrong views of trading, which is stacking odds, like we were saying. It's not. There's no certainty. There really is no certainty. I mean, each trade is effectively a guess at what the market can do. And then there's money, because a lot of traders do great as long as they're in a demo account. And then the moment that they shift over to a live account, all these good intentions just get thrown out the window. Because when when you're dealing with money, people sort of start getting dominated by emotions. And it's difficult. It's not easy, because to be a good trader, you have to go against your natural impulses. You have to go against your biology a little bit. And now just a personal recollection. From a personal perspective, I knew back in the day, just out of university, I went to work for a boutique retail broker in Italy, and we were the best broker in the country at that time, and I was surrounded by a couple of profitable traders who were market veterans, but I was also surrounded by some money managers that were consistently losing money time after time. So as a university graduate with a little experience, but with a lot of passion for the markets, I knew that there were different ways to play this game. I knew that most people ultimately fail when they try this, but I also sort of knew that there were some good principles to follow. So I tried to follow them. But without, the interaction with successful traders and seeing these failing traders around you, it really is difficult to generate any kind of confidence that, what I'm doing is sound, or that this is something that actually works. But let me take you back to that time and show you I guess you could call it my beginner's luck. This is back in 2009. It was August 2009, and I still remember this very vividly, just because of the impact that it had on me back then. So back then we had a wealthy client who he would call us every 3 minutes, basically checking on prices. Business owner would get up 5 in the morning. He's overly active and maybe a compulsive gambler. So one week in August, when the office was particularly empty, he asked me if I would help him to do better. And I said, sure. But just remember that I'm not, I'm not managing your account. So what I'll do is I will suggest a course of action, and you will tell me whether you accept that or not. And that's what we did. So this is a situation. The week was starting, and this is sterling yen. So the week was starting up here near previous resistance. And sorry, let me just show you one thing. So what I noticed, what I was looking at back at the time, of course, were the key support and resistance levels. I also had studied above and beyond everything on technical analysis. So I also noticed that there was a daily divergence in momentum up near the highs here. It hadn't been confirmed yet. Just into the Monday, we started getting some negative momentum there to confirm it. I knew that I was supposed to trade trends, but maybe something was turning around here. So, but I was uncertain, but I had a feeling for certain things, and that's what I did with him. I knew that he was overtrading. I knew that we had to be selective. I knew that we had to be cautious and try and align the stars as much as possible, whatever that meant back in the day. And this is what happened. So I didn't understand markets very much on the Monday, so I just waited for the Tuesday. Now, in retrospect, what I was actually uncertain about was the hourly trend, because I saw the fall, but without seeing precise swing highs and lows, or without seeing some stair-stepping motion, I was just staying still, and I didn't really trust it. However, into the Tuesday, we got our first opportunity, and what I was doing there is I basically played a pullback into the hourly trend. You can see we posted some lower highs and lower lows, and I was playing a sub-hourly pullback into that trend, and I also played another one later in the day. And that's basically the strategy I was applying at the time. So I was following momentum on the hourly frame first, taking my big picture view from the daily chart, and then making sure there was hourly momentum, and then playing sub-hourly pullbacks into that momentum. Here where the X is, this is the stop out that we had during that week, but it was a very fortunate week for me, being the first week actually, I'm going to say managing money for a client, even though legally it wasn't that way, but in practice it actually was. And then on the Friday, once again, when things clicked back into gear, I was doing the same thing. This is a 15-minute chart of where I was entering the trades, and this is the process that I was following back then. So taking my cues from the two professional traders that were in the room at the time, when I asked them what they were doing and what they learned to do, they said, well, just come in, read the news, and then see what it means for foreign exchange flows. See if any of the news might mean dollar demand or dollar supply or risk on, risk off, etc. It was very brief. I mean, that was the explanation. There was no detail given. And then the second thing is, are your charts moving as you would expect given that news? If they are, great, it's confidence. If they aren't, just wait and see. Then my personal, overlays were, is the 1 hour flowing nicely? Because I had to make sure the market was making sense to me. And then I would finally play a pullback into the 1 hour trend. At the time, I think I was using Fibonacci's as well, but it doesn't really matter. The key was that the background structure was this. So after that, when I went solo, trading privately, it took me about 4 years to essentially, go around in circles and to come out with essentially the same approach, but with a different kind of confidence, because I knew that I had been sort of lucky during that week, and we were trading, $4 to $6 clips for this client. I'm sorry, for $4 to $6 jargon, between 4 million and 6 million on each trade. That was the trade size back then with this client. So, for me, it was a decent experience. But I also learned that I didn't have the confidence to really do that, and I wanted to generate that confidence. I also knew that I was doing something right, because during that same week, some of the guys were losing money on the desk. And with that, I'd just like to say that it was my sort of beginner's luck, and it took a while to actually generate the kind of confidence it takes to do that in a systematic manner, on your own account. So going on to the second issue. A second issue that I see very often is that people use technical analysis to justify their own views. I've taken these snapshots from a famous social trading platform, just as examples. I mean, I'm not criticizing the people that put out these ideas, because sometimes I'm wrong. We're always wrong, so it's not a matter of always being right or of always knowing the truth or whatever. We're always playing odds. So I could say markets are bullish today and be wrong. That's not really the question. The issue here is that the analysis being used is really being used to justify a view of what should happen based on these guys' ideas. And this is very different from what it takes to be a successful trader. To be a successful trader, you need to pay attention to what's happening and not plan ahead what you think will happen, or act in a manner consistent with what you think will happen. You have to have a strategy that allows you to be objective regarding what's happening right here, right now. And all of this, this is rather hilarious, but it means nothing, because the markets really don't care about wave counts. They don't care about indicators. The markets don't care about wavy lines or the best laid out plans. Things can change in a heartbeat. Yesterday, just as an example, yesterday President Trump came out with a tweet just briefly hypothesizing. So it was just a hypothesis, just putting it out there, right? That he might want to delay the elections. And the euro shot up 50 pips in a matter, I think it was in 20 minutes, 25 minutes. So, anything can happen at any time. And all of this planning ahead is frankly useless. And the other thing is that then people get emotional about their calls, and getting emotional, of course, takes attention away from an objective point of view. And it gets you, once again, into your own head. It gets you into your own emotions. And when you put an idea out there, you're always, trying to be right and fearful of being wrong, fearful of being criticized. And it's just, and it's an issue. It really is an issue that blocks your consistency. So let me give you my personal solution to this second issue. Okay, the first issue was my first personal issue was confidence, and that only comes with practice, with years of disciplined repetition of doing the same thing. And I might add, getting in touch with professionals that have been there and that have done that and that can guide you. At FCI, we are here to guide you. Back in the day, I didn't have this. I wish I had this. I was fortunate enough to stumble across some market professionals back in the day that gave me a hand, that gave me the confidence that was necessary. But now you have us at FCI. This is what we're here to do. Issue number two, okay, being objective about the market and not trading your own ideas. Here are the right questions to ask. Number one, is the market going anywhere in an evident manner? Okay, and this is what I call the 10-second test. I did a video on this. It's on our YouTube channel. You can go and see it. Basically, you look at a chart, and if within 10 seconds you can't say whether it's going up or down, it's probably not doing anything important, and you should avoid it. The second thing, are there any elements of caution? I have an example that we'll see shortly, but on the euro, for example, the euro has been going up steadily for the past month, and we're at 5-year highs, so it's going somewhere. Are there elements of caution? Well, yes, because as you approach strong previous resistance points, you might want to pay attention. As you approach, as you see divergences in momentum, you might want to pay attention. Does that mean that the trend is going to change? No, but it impacts the risk reward of trading right there, right then. Okay, I have charts, so we'll see this in a bit. Yeah, the risk reward of trading changes depending on your location on the charts and depending on the flows, what's going on, and the themes. It's not constant every day. It's not constant at every place on the chart. Then, number 4, is the market currently trading in the same direction as the trend? This means that the trend may be going up on a broad daily chart or over the course of the past 2 or 3 months. But maybe in the past week, it's moving against that trend. So you need to wait until the stars align. Otherwise, you will end out fading momentum, which is never a good idea. And then you need to ask yourself, depending on what the market is doing, where's my long trigger and where's my stop? And then you just wait for it. Or if you're short, where's my short trigger and where's my stop? These are just questions to ask yourself. They ensure that you remain objective about the markets. So let's go and see this in practice. I took the snapshot a couple of days ago, so we've gone a little further than this, but the euro, is it going anywhere in an evident manner? 10 seconds. You can tell me on the chat box if you want. Okay, it's going up, no doubt about it. So are there any elements of caution that you can see just from this chart? Okay, just from this chart here, because even indicators and stuff, they can only assist you to see things that you could see with your own eyes if you know the dynamics, but they just sort of highlight it. So elements of caution in this uptrend. If I were to trade right here, right now, what are the odds? What does it look like? Okay, Nick is saying, yeah, CCI is diverging. Very true. And we actually highlighted that a couple of days ago on the on our Twitter feed. That's right. There's a divergence in momentum. So it's showing you that the push up, okay, from this high, this push up actually was weaker than the initial push. So the divergence in momentum is, it's a bit of a warning. The thing to know, though, is that in a strong trend, you can have various divergences in momentum. It just won't stop the trend. So it is caution, but it doesn't actually mean that the thing is going to turn around. And this is I guess this is a subtlety about technical analysis and setups. When you see a setup, independently from how great the setup is, it doesn't actually imply that it will work this time around. It will have a long-term, it'll have long-term statistics that justify it. But right here, right now, we really don't know what's going to happen. Each trade is an independent bet. So definitely caution. The other thing that I would add is that we have had, 8 or 9 daily closes all in the same direction. So 8 or 9 higher daily lows and highs. So we're in an extended uptrend. It's great to be trading in this environment. It's great to be holding onto positions and maybe adding to your positions. But as the trend grows, it becomes more and more probable that you will have a pullback. So, element of caution. As long as you're aware of this, it'll help you. There's exactly what we were talking about there. The other thing is September 2018 highs around the 118 handle. So we hadn't transacted them yet, but we were getting close. So that it's worth paying attention. So next thing, so we talked about the big picture. We talked about some elements of caution to be aware of. Next step. Is the market currently trading in the direction of the overall trend? I've tried to draw just a line connecting swing points here on the hourly chart. Does anybody want to guess what the situation was, what I was sort of thinking when I took the snapshot? What would you do? Okay, a couple interesting, yeah, that's right, interesting answers here. Bet right now, up or down. Um, Gavin says, long at the red line. And then one says, I'd short it. Okay, so here's how I was interpreting this at the time. So the day prior, okay, the day prior to the 29th when I took the snapshot, we actually had a negative day, a down day, so a pullback within this broader trend. We didn't violate 117, so we actually found a base at 117. That's positive, okay, round number, acting as support. We didn't close back down below the previous day's lows, so we didn't actually, turn the previous day's gains on their head, and that's another positive. However, the actual cycle, the high and low cycle, so the trending cycle, the hourly chart, which is something that I was paying attention to from way back in 2009, as I showed you, wasn't really flowing upwards. And what I was actually waiting for here was a higher low. To me, we were basically pulling back within the context of a bit of negative momentum here. And the first sign that the trend was going to resume, so the first sign that would have given me confidence to actually start trading in the direction of this trend again, would have been an hourly higher low. Because otherwise this just looks like, swing points are going down, and then you get this pullback up near previous day's highs. I would like to wait for a higher low, so it actually shows me the pullback cycle is back in action. And I guess this goes back to having patience. There are different ways of confronting the markets, of course. I'm just showing you what makes sense to me. And actually on our Twitter feed, we actually posted a divergence short up here on the sub-hourly timeframes. So, putting your money where your mouth is, we were short. We were showing a short up here because the odds were that this had to go down and actually form a higher low before it was going to come back up. I don't really know what will happen. Maybe later we'll go into a live chart. So I guess what I'm saying here is that you need to analyze the market day by day and always be cautious of what the short-term flows are showing you, not just what the overall big trend is doing, because you want to align the big guy with the smaller trends. Oh, there we go. I'm sorry. That was our short call up there. I actually took a screenshot of it with the divergence. And as we were waiting for a higher low, the higher low, as Gavin said, it would have been nice if it came in along this red line, which was previous resistance. I think it overshot it. It actually went lower, so we'll see. Issue number 3. So we've gone through the issue number 1 of system hopping, confidence, etc. Issue number 2, which was trading objectively and not trading what you think you see. So using technical analysis to aid you and not using technical analysis to see what you want to see. Number 3, other hindrances to consistency are drawdowns. This is a big one because everybody and their dog would like to see a 45-degree upward sloping angle on their equity curve. Okay, so everybody would like to see something like this from the moment they start trading till infinity. But that never happens. It's just a reality about this job. You can be as good as you want, but drawdowns do happen. And I want to tell you about the biggest drawdown that happened to me in recent history. To give you a bit of background, I was prior to joining FCI, I was managing trading signals for business. This is my personal performance from 2017 to 2020. And this is my biggest drawdown. So why do drawdowns kill traders? Well, the first thing is that people hate to lose. So in the first part of the webinar, we talked about the psychological impact of trading, right? The patience part, the fact that when you're dealing with real money, the best laid plans just get thrown out the window, and that it is objectively difficult to do this because each trade is based on your best guess. And your best guess may be wrong. And you will never have certainty that your next best guess will be right. So how do you deal with this? How do you really deal with the fact that you can hit a rough patch, and you have to have the confidence to keep fighting and to get your equity curve back up? There are a couple of answers to this. I'm just going to have a sip of tea. There we go. So here are the considerations that were popping through my mind when I was going through that. So the first thing is it the market or is it me? Okay, market dynamics change. And like I said before, any system will have moments of where the sun is shining and you're making hay, but they will also have moments that's very difficult and you get chopped up. So knowing or having a feeling for, having the experience to know whether it is the market or whether it's your system or whether it's you as a trader is important. The second thing is, if between these three components, between market dynamics, my system, and myself, in what percentage do I have to allocate the accountability? In what percentage? Where's the main problem? And in my case, I really had to ask myself, in what percentage is it actually me? And I'll clarify that in a moment. First, let's go and check market dynamics. So the drawdown happened at the beginning of 2019. And what you can see here at the beginning of 2019 is that there was a sharp drop in volatility. I mean, seriously, volatility just collapsed. And we entered a range-bound environment that was, for my system, for my model, that's based on trend and momentum. It was difficult to trade because every boost of momentum in one direction would then be followed by a reversal. So it was a very challenging time, and also it was a time when news events started picking up across the globe. So we had unscheduled announcements, we had geopolitical developments, we had civil unrest rising. There was traditional economic news started losing significance, and the unscheduled events just started taking precedence. So there was a lot of intraday to be done during 2019 as the volatility was collapsing overall. But for my system, it wasn't an ideal environment. I would have had to be more flexible. And it is possible, of course. This is one of the keys of a successful trader, which is being a little bit flexible and taking your system apart, using just the bits and pieces that can be used in the current market environment. And that might mean being more selective. That might mean being more cautious. But ultimately, you have to know what environments are good for your trading system and which aren't. And I was sort of slow to adapt. The other thing is that for me personally, managing a business, I was fatigued, and I was fatigued already before the drawdown hit. I was fatigued since the summer of 2018 for various reasons. So personal analysis, I knew I was fatigued. I had taken a couple of breaks from trading just to keep my energy levels up. But as you can see, I'd failed to break to new highs. So it was showing. My fatigue was showing in my own equity curve, and I knew it. And so I was not in the best position to face the changes in market dynamics and to react quickly. So there was and you have to face up to this. So a lot of people, unfortunately, have trouble facing the truth. But the truth is the only thing that actually sets you free. The truth is the only thing that will allow you to grow in any aspect of your life, not just in trading. You have to be able to say, yes, I screwed up. I know I did, but I was able to limit the damage. Nobody died, and I've learned something. I actually recently had a conversation with a former student of mine, and he was, he's going for a very important position, a very important job position, and he went through the round of testing. The thing is, he had put so much pressure on himself because this job means a lot to him, and he put so much pressure on himself that he wasn't himself. He didn't perform as he usually does. And he was, and so he talked to me saying, maybe I need to revisit some things, or maybe I need to take a step back. I don't know what happened, etc. He didn't suck, but he just wasn't his best. And initially it was tough for him to sort of accept this, that he wasn't infallible, because he's a person of excellence. Like many traders that strive, that survive for many years, strive to be people of excellence in the markets. He's a person of excellence. So when he's not at his best, it's a hindrance. But talking through it, I helped him come to the conclusion that he just screwed up, because we're all human and we all screw up from time to time. The important thing is what you do after. Do you learn from it, or do you just, close up like a porcupine, into a ball? So this is, I'm just, I guess I'm telling you a bit of the personal aspect behind trading full-time, trading as a business, and what it means and what it takes. It's a performance endeavor, so each and every day you have to try and be at your best, and it's not easy. So the market dynamics changed. I was fatigued. I hit the drawdown. What did I do? The first thing was I reduced position size. So this looked really steep. It would have been even steeper if I hadn't started cutting position size. I think I cut it late. I think I lasted 2 months with the same position size before cutting. That was way too long. I reduced trade frequency, and then I eventually cut the position size to a quarter of what it usually was. So those things combined gave me breathing room. And despite the lamentations from clients that always want higher trade frequency and they want you to turn their accounts day after day, I resisted that temptation and gradually, got back into a better place. Started working my way back up the curve, and I maintained the quarter size position for the whole of this rise. I think just at the end, this captures up to, I think, January 2020. This continues up to April 2020, and that's where we actually reached back up the old equity peaks. But that's really that's the story. That's how you survive the drawdowns, and this is a personal account of what it takes to do that. Most people can't. The moment they hit, most people, they want this kind of equity curve, and it leads to some, really dumb systems that I'm going to show you now. That's why I call this the bonus issue, holding on to losses and using negative skew strategies. Because if you can't tolerate drawdowns, if you really can't muster the drawdown, then you're the easy way out. Okay, the cheap way out is to use a negative skew strategy, which is what you see here. And this isn't even bad. I'll show you some worse stuff after. But this is a strategy that is employed by one of my former employers. So it's a guy I know personally, and I know that he's had, issues with this kind of strategy before. But why do they do it? Why do they continue using this kind of system? Because it's easy on the mind. You take minuscule profits, okay, and when the system goes into a drawdown, you hold on to it. That's the absurd thing. You are holding on to large drawdowns, and you can see here from wherever it was, the system went back down to 0 and just below 0. Then it recovered because negative skew strategies have high win rates, which is nice and easy on the mind. But then, the losses are big. Then the losses tend to be a lot larger than the gains. And that's what you see up here. You can see how the drawdowns start to get a lot bigger. You're taking, and they are 10 times the size of the gains. And people just hold on to these losses. So you have your actual equity in your account that is perhaps, it's only up at 3.5%. But your consolidated equity is up past 5%. It's at 7% or whatever it is here at 8%. But that's not the real money you have in your account. Your actual account is still back down here. Now you understand what the risk is of these strategies. Okay, you can really manipulate the numbers depending on what you show people. Because up here you can see the gains are great, a monthly gain of 3.4%. Yeah, sure, but you're holding on to a strategy that is overall negative and it's eating into your equity. So you're not making money. It looks like you are, but you're not, because you're holding on to all these losses. There was a very famous copy trader that was, he's one of the most famous on the internet many years ago, that had a ton of people following him. And I think it took him 3 years to recover a drawdown like this, because he was doing the same thing. He was taking minuscule profits, holding on to losses, saying, yeah, it'll come back, it'll come back, it'll come back. What if it doesn't? Are you really going to tolerate this? What investor is going to tolerate this kind of treatment? Okay, now this is a little better, but not much. Okay, it's the same kind of strategy, and this is just not the proper way to trade. There are a ton of systems like this going around that want to entice people to subscribe or to follow this kind of trading, and I would say just don't do it. It is not the way you trade. It's not only inefficient, it's actually dangerous to your account. And it's just caused by that same issue, not being able to tolerate losses or drawdowns, and looking for the cheap way out. So the fourth hindrance to consistent trading is holding on, I guess, risk-adjusted ideas, but holding on to losses. Any trade that myself or Kevin or Paul, the other guys at FCI, will take is a risk-adjusted trade, which means that the odds ahead of placing the trade seem favorable, which means that the trade has space to run. If it's a news trade, there is a reason for taking the trade in the first place that has significance. If it's a technical trade, then there are reasons to get in the trade. There's a very precise stop loss that will get us out of the trade, and the profit target is initially at least a bit further away than our stop loss. Compare that, these risk-adjusted ideas, to what you see normally. Now, this is a screenshot taken from a retail broker that shows client positions. Now, these are open positions. Now, the euro is currently trading around 119. This morning it was around 119. Notice how there are short positions that are still open from 115 and change, 115.50, and probably even lower. Just like there are long positions that are open from all the way above 120.20. And I took this screenshot a couple of days ago, so things will be things were even worse for these longs, and now things are worse for the shorts. I've seen people hold trades for 2, 3, 4, 5, 7, 800 pips. And you have to ask yourself, what is that? What are you doing? Because trading is a game where you have to stack the odds in your favor. And one of the edges that you need to exploit is a positive risk-reward ratio. Cutting your losses. All the market wizards talk about this. They say, cut your losses. Ed Seykota. The first 4 rules of his trading are cut losses, cut losses, cut losses, and see above. So holding on to losses is something that many traders do, and those negative skew strategies do, and it's something that will kill your account. You need to have good risk-adjusted ideas in order to do this full-time for a long time and survive. And since we're coming up to the end of the webinar, I'm going to share some of these risk-adjusted ideas with you. And then just know that in the next webinars, we will take this forward. We will actually execute and manage these risk-adjusted ideas and see how they play out, and see what kind of mentality, what kind of style, what kind of trader they cater to, because they're all very different. The first thing is very simple. Visually, what you're doing here is you are taking your direction from the weekly opening print, that's this big line here, and the daily pivot. It's a classic pivot, nothing, it's nothing complex. It's a classic pivot. It's the previous day's high, low, and close divided by 3. and it gives you a balancing point. So all you're doing here is you're asking for a little balance, okay? You're saying, okay, these two levels tell me, what the line of least resistance is, where the pressure is, where momentum is. And I will only trade short if I'm below them, and I will only trade long if I'm above them. And then all you do is you play pullbacks in that direction. So, use an oscillator, use a momentum oscillator. It could be a stochastic, it could be a rate of change, it could be a CCI, it could be an RSI. Choose your favorite. They're all more or less the same. And then, wait till it's an overbought, and then wait till it actually triggers a trade and see what happens. Okay, these are some examples. These are the rules. To answer your question there, yes, the meeting will be recorded, and it will be sent to all participants. So you will always be able to review these rules, but they're really, really simple. Next one. Okay, so I gave you first idea. Now, first risk-adjusted idea. Now the second one. The second one we're going to call self-similarity. We're going to use a combination of time frames to help us get on the right side of the market. So the first step here is taking a look at the daily chart. This is cable from a couple of days ago. So 10-second test, up or down. We're going up. Take note of the next couple of resistances, next couple of big resistance areas that are in front of you. Take note of the previous supports that are behind you, and then take note of any other flip points or any other interesting points, but keep it light on its feet. Okay, there should be very few lines on your chart, just the really important ones, because this is your big picture. Next, we're going to ask the market if it's trading in the direction of the trend. So the momentum time frame. Momentum time frame, you're asking the same question, up or down. It is going up, it's flowing in line with the daily chart. And you can see how the levels that we highlighted from the daily chart actually stack up with previous week's highs and lows, and key swing points that really contain price and acted as support resistance on the way up. So they are key reactive levels. You don't need anything else on your charts. Then you go on to the execution time frame. So in this case, we are executing not from a 15-minute chart like we were doing before. We're executing from an hourly chart. So whereas the idea from before is for intraday, this is for multi-day or swing. And all we're doing is we are looking for that sort of same dynamic where if you have all three time frames flowing in the same direction, all you do is you wait for those pullbacks on your oscillator, accompanied by the usual candle prints that we all love to see. Most traders have studied the candle prints inside and out, front and back, and all we're doing is we are just waiting for them to appear once we have our overbought signals. And you can see they appeared. If they appear at a key level, it's even better. It makes it, gives you a bit of confluence. Here are the rules, and as usual, you will be able to review these on the recording. The next one, we're going to see something a little different. We wrote about this in some blog posts time ago. This is for people that just can't get out of that mentality of fading trends or catching tops and bottoms. So if you want to catch tops and bottoms, here is one way to do it where at least you're limiting your risk and you have a defined setup to wait for. Okay, you have precise rules. It doesn't guarantee success, but at least you're not doing what most traders do, which is holding on to losses and just trying to catch tops and bottoms blindly. So what are we doing here? The rules are extremely simple. We're using Bollinger Bands to tell us when prices are getting exuberant. Okay, it's just an idea. When are prices overshooting a little bit? When they start closing on a daily basis outside of the Bollinger Band. And I've highlighted some of those instances here that we're going to focus on. Because once the thing closes outside the Bollinger Band, you're then waiting for a precise signal, a 4-hour divergence. So the daily is potentially overbought or oversold. Then you go into the 4 hour and you wait for a divergence, and it should be as clear as daylight. Okay, if you have to stare at your charts, okay, if you have to spend more than 10 seconds identifying a divergence, then it's not there, and just avoid it. And I've highlighted some of these divergences. Okay, these are from the previous chart. This is a multi-time frame Bollinger just to show you where on the daily chart we were. And this is the kind of setup that you're looking for. And this setup, does this setup frequently mean revert all the way down to the other Bollinger? No. And sometimes the setup will fail because you are fighting a trend after all. But at least if you like the contrarian mindset and you just can't get away from it, then this is a setup that can help you to stack the odds a little more firmly in your favor. If you go onto our blogs from June, you also see another way of using this sort of contrarian mindset using the 15-minute chart. So dropping down a couple of time frames and using this on an intraday basis. But the principles are always the same. Here are the 2 rules. There are only 2 rules to this contrarian system. Very simple. I like to say elegant. And of course, I'm just showing you some rules that make sense to me personally, and some rules that make sense to the traders that are here at FCI Markets. But there are many other ways to confront the markets. These are just some examples. You will have to eventually find your own niche using solid principles, and we can give you the solid principles. For example, our head trader Kevin has been in some of the largest hedge funds in the world, and he's been a prop trader for over 30 years. So we can definitely give you solid principles to base your system on, but then you do have to take that extra step and experiment and do the work yourself. Don't think that you can just take a recipe, apply it, and bam, it's like baking a cake and you come up with the same result. You do have to learn it. You have to make it yours. And whatever you do, remain consistent. Even if you're just trying out a strategy, you need to make it consistent, even if it sucks. Record that with consistency. Attach your trading platform up to MyFixBook or another independent trade statistics program, so that you can actually see, what kind of numbers your trading is spewing out, and that will help you understand, whether there is something worthwhile in there, or whether there isn't. And it's a good practice in any case, because you always have to measure what you're doing. It's not really a case of what feels good, although you have to trade to your strengths. It's a matter of what turns out good numbers and makes money over time. And you have to remain consistent when you do your trials. So, I think it was Mark Douglas who said, take 20 trades in a very consistent manner, using the same rules time after time, and then record the results, and then make your conclusions. People just aren't able to do this, though. They just go all over the place. They've fallen through the cracks. And the four hindrances to consistency that we talked about in the webinar pop up time and time again in one form or another. So, yeah, just remain consistent. And of course, we're here for you. If you need guidance, here are a few things that you can do. Subscribe to our Thought Leadership blog. We write on this blog each week with a mixture of articles and videos. So, just go down to the bottom right and click on the subscribe button. The second thing is follow our Twitter calls. Between myself and Kevin, we're populating this in a low frequency, high quality way, because throughout the day, there's a ton of things that are always happening in the markets, but very few actually matter. So, and that's what we're doing. We're filtering through everything just to give you the juice, just to give you, the best possible insights. And finally, if you want to transition from a profitable retail trader to a professional trader, then just come to our academy. We are preparing a fully fledged academy. It's almost ready. and I will personally guide you through the whole process. It lasts a month, and it takes you through all the steps from trade idea generation all the way through trade management, psychology, and you can get in touch with our traders at FCI Markets. If you're in the UK, you can come and do it at our premises. It's, this is our offering for helping you become a professional trader and a funded trader. Because as I said at the beginning of this presentation, we want to find passionate traders that can then qualify for fully funded accounts. That is our goal. And everything that we do is directed at that one goal. We want you to be successful, because if you're successful, then we are successful as a business, and people helping people, the best of both worlds. If you have any questions, if anything isn't clear, you have any questions, if you enjoyed the webinar, then just get in touch. You can write us at client.support@fcimarkets.co.uk. Give us a call if you want to talk to us directly, or come and visit us. We really do. We try to offer you the best trading conditions that are present on the retail market. Between our spreads, our liquidity, our liquidity providers have won various awards over the years. Some professional traders that trade with us have said great things. And actually, FCI was born because a group of large traders needed decent liquidity for their trading. And so the kind of conditions you can find at FCI for FX trading especially is unparalleled. And on top of that, now you also have the support, the education, and the means to become a funded trader yourself. So I'm just going to open up the stage for some questions. But other than that, I'll just wish you all the best with your trading. So any questions, let them roll. I'm here on the chat. Let me know anything. The only dumb question is the one that you keep to yourself. I have a question here on copy trading. Yes, we are setting up copy trading. One of our managers is currently working on the copy trading solution. And I don't know your personal situation, but if you are a high net worth individual, you should go over to FCI Capital Management, where we actually have managed accounts. So depending on your situation, on the retail side, a bit more patience, but we are setting up a copy trading solution where you will be able to copy our systems and our managers, which is something I frankly haven't seen anywhere else. It's a great opportunity. And if you're a high net worth individual, then go over to FCI Capital Management, and you will find all the information over there. All right, no other questions. Then I'm just going to thank you all for taking time out of your day to come. I hope you enjoyed this webinar. Just remember that this is the first of a 4-webinar series, and it will take you from trade idea generation all the way through to trading psychology. Thank you very much. This is Justin Paolini for FCI Markets.